just take a look at today's Wall Street Journal. Inflation worries spread. You've got basically inflation jitters spread through emerging markets. In Brazil, Latin America's largest economy, the government reported Tuesday that inflation is accelerating. We've got inflation popping up in other parts of the world. After all, many countries peg their currencies to the U.S. dollar. And my basic question is, to what extent do you think the Fed's monetary policy stance has contributed to these global inflationary pressures? Has this contributed to the hot money flows abroad that have led to some of these global imbalances that are not fully appreciating when we examine the costs and benefits of your current QE2 monetary policy stance?
Mr. Chairman, your first sentence under the headline was very revealing. The inflation is taking place in emerging markets because that's where the growth is, that's where the demand is, and that's where, in some cases, the economies are overheating. It's the responsibility of the emerging markets to set their monetary and exchange rate policies in a way that will keep their economies on a stable path. The increases in oil prices, for example, are entirely due, according to the International Energy Agency, to increases in demand coming from emerging markets. They're not coming from the United States. So the bulk of the increase in commodity prices is a global phenomenon. In the United States, inflation made here in the U.S. is very, very low. Now, of course, that's a serious problem, but monetary policy can't do anything about, for example, bad weather in Russia or increases in demand for oil in Brazil and China. What we can do is try and get stable prices and growth here in the United States.
So as you look at some of the leading indicators, the yield curve, for instance, commodity prices, do those not send you a warning that inflation is building in America, or are you still looking at core inflation as your main guidepost to measuring whether or not monetary policy is keeping prices in check? My basic question is, my concern is, using your output gap model, my fear is you're going to catch it before the cow's out of the barn. You're going to see inflation after it's already been launched. And given that you have a huge balance sheet, given that we are basically in uncharted territory with respect to the Great Recession and the responses that you put out there, that we're going to catch this after it's too late. Could you please give us a sense of what else you're looking at to gauge inflation in America other than core inflation, which, as you know, there's a big debate as to whether or not that's the proper tool we use or not. Even the ECB uses broader definitions of inflation. So where are you looking outside of your core deflation to give you a gauge as to how to set monetary policy to prevent inflation from actually getting unhinged here in America?
Mr. Chairman, let me say first that there'd be no doubt that we are unwaveringly committed to maintaining price stability. That is a very, very strong goal and objective. We will do so. In terms of what we are looking at, first of all, overall inflation, including food and energy, is still very low, about 1%. But looking forward, you asked about credibility in the yield curve. If you look, for example, at inflation break-evens, which are a measure in the inflation index bond market of what the markets think inflation is going to be, the 5-year break-even is about 2%, 2.1% last I looked. So there is not really any indication in our financial markets that in the United States there's an expectation of inflation. That being said, we will look very carefully not only at output gaps and those things that you mentioned, but also at commodity prices, at interest rates, and all the other indicators that will help us assess when inflation is becoming a problem. It is always an issue, as you know, Mr. Chairman, that in the recovery period, you have to pick the right moment to begin removing accommodation and taking away the punch bowl. And we, of course, face that problem as the central bank always does, but we are committed to making sure that we do it at the right time.
So when you see the steepening of the yield curve that's taken place recently, do you see that as market participants showing some concerns about future inflation, or do you see that as signs that an economic recovery is beginning to take root?
The inflation break-evens have risen since we began the QE2 program in August, but they have moved from very low levels to about normal levels. The bulk of the increase in interest rates has been in the real side of the interest rate, which means that, like the stock market, the bond market is expecting greater future growth and is more optimistic about the U.S. economy. And I think that's a good thing, obviously, and I think our policies have contributed to that.